Okay, so another simple way by which you can calculate your pips is using the crosshair tool, which is this tool over here. This over here, the plus. Now, one thing is that you take it from the point where you want to calculate the pip. So let's say we want to check the pip movement from point A, which is this point over here, to point B, which is this zone over here. Let's say all the way here. All the way here. We want to check the pip movement. Now, what you do is that you go ahead and select the crosshair tool. After selecting it, you take it to the exact point where you want to start from, and then you left click, drag it to the point where you want to know the amount of pips that you have moved to this point. So now you are going to be seeing three numbers, right? You are going to see 47 bars, 591.0 points, and then 0.32%. That's the change. I hope you guys are all seeing that.
Yes.
Good. So the moment you are seeing the 47 bars, 591 or 5,910 points, all that you have to do is to look at the points. So when you see the points, just ignore the last number. That is the 0. And then you've moved 591 pips. That is as easy as that. This is one of the easiest ways to calculate the pips. Also, you can take the price of the initial, the current point that you had, and then subtract it from the first point, and then you are still going to get the same number. So that is basically how it works. Oh, sorry. From here to this point. Now, one thing is that this broker writes its digits to what? To 3 decimal places. So you ignore the last two. Please ignore the last two. That is the 1 and then the 3 with the points. So anytime that you use the crosshair, just look at the points, and then you drag. Just look at the part written points, and then ignore the last two. That's the 1 and then the 3, and then look at the 58. Now, if the broker writes it to the 3 decimal place, that is when you look at it like that. But if the broker writes it to 2 decimal place, ignore the last one. Now let's look at it for a different set. Let's say GBP USD, right? Now we want to calculate the price movement let's say we want to calculate the price movement from this point to this point. Now what do? We take our crosshair, the points that we want to start from here, all the way down to this point. Now what do? We just ignore the last point, the last digit. So from the top to the down part, we have moved 24 pips or 240 points. This is it. This is the whole issue with pips at them points. This is the whole thing with pips at them points. So I hope I do not have any questions. Okay. Let's continue. Now, I was saying that we are going to look at lot size next. Have I talked about lot size? Let's talk about lot size. I'm going to talk about time. Okay. So let's continue. So with lot size, it's just referring to the amount of shares or currencies, since you are trading forex, you buy in one transaction. Either you are buying or you are selling, right? So the amount of units that you are purchasing is the lot size. And then if you remember when I was talking about leverage, I said that initially for you to be part of the forex market, you needed what? A standard lot of what? 100,000 units. So a standard lot is just one lot size. One lot. This is how it looks like. And then this means that you are purchasing 100,000 units. So let's take it that. Let's take this example. Let's say that the price of GBP USD is 1. Let me take 1, 2, 3, 4, 5. You get this? So now for me to get this amount of money, for me to be able to purchase just a standard lot of this, the one lot size is also known as a standard lot. For me to be able to purchase GBP USD at one lot size, I need 100,000, 100 and I'm coming. I need this amount of money. How am I even going to mention it? So I need 112,345 USD for me to purchase one lot size. So you see how important leverage is. This is how much I needed. In case, should we say that the price of one particular, let's say the asset of GBP USD is what? 1.2345. We needed 112,345 USD to purchase one lot size. You get it? So this is the lot size that, and then the lot size tells you what the volume in which you are buying. So we are having, so when the retail traders came in, initially, first, for you to be able to purchase in the market, you just needed what? A standard lot size. But now when the retail traders came in, we realized that the interbanks realized that retail traders are not having a lot of money. So what can they do? They can leverage our account for us. So instead of using a one lot size, they brought about this, which is a mini lot size. You get it? So let's call the standard. And then we will call this mini lot size, which is 0.1 lot, which is equal to what? 10,000 units. And then similarly, we are having a micro lot size, which is what? 0.001 lot, which gives you what? 1,000 units. And then we are even having a nano lot size. This one, I know most people have not heard it, because for some time now, a lot of brokers do not employ nano lot size, which just means 100 units. So based on the value of the currency pair, each currency pair is having what? A different value. So let's say that the value of one particular pair, let's say gold, one pip equals $1 US. I'm just giving a hypothetical situation. Let's say 1 pip equals 1 USD. So it means that when you buy a standard lot, and then when you buy gold for one standard lot, every pip movement, if it goes in profit, it means that you are going to make $1. So 10 pips becomes what? $10. That is if you buy what? A mini lot. That is if you buy a mini lot. Now, the reason why this thing interchanges with standard lot and a mini lot is that the value of a currency pair changes over time. So sometimes you would buy gold and then at one lot size, then it moves at $1 per pip. Sometimes it moves at $10 per pip, depending on the value. So if hypothetically gold is having one pip equals $1, then for a standard lot, anytime that gold moves, this is a whole hypothetical situation. I'm not saying that this is what will happen, but if we are to calculate for the value of gold right now, we are going to know a different thing for 1 pip. Per standard lot, we are going to take what? $10. So it means that when you move 1 pip right now, when you place a 1 lot size and you move 1 pip in profit, you are going to make $10. If you move in loss, you are going to make negative $10, which means that your account will be red. Similarly, if you use a micro lot size of 0.1, you are going to make what? $1. If you use a micro lot size of 0.001, you are going to make 1 cent. Are you guys getting it? So let's say that with this pip value, if you move if price moves in your direction 1 pip, you are going to make $1. That's $10. We are taking that the value is what? One pip for gold. Now with this, the same 1 pip, you are going to earn $1. Similarly with this, the same 1 pip movement, you are going to earn 0.1 cents. The same 1 pip movement. Now with this, how much are you going to make? You're going to make pennies. So this is it. This is basically what your lot size represents. So if you're having a $50 account and then you choose a leverage of 1:, let's say 1:100, it means you can use this kind of lot size. Now the most important thing is that if you are having a $50 account and then you use the leverage of 1:100, it means you are multiplying your account size by what? 100. So you are moving what? You are now having a purchasing power of $5,000. Since you're having a purchasing power of $5,000, you can accumulate 5 micro lots. That means the maximum trades that you can pick will be what? 0.5 lot, because of the leverage that you have. You get it? Because this is your maximum for a $50 account. This would be your maximum. Hope you guys are getting it. Hello.
Yeah. We are getting it. I'm with you. Sorry.
Okay. So now let's look at the stop loss and then the take profit. If you understand. Now, a question that I got a lot today was what is stop loss? What is take profit? Initially, this is not what I was supposed to teach today, but this just came. I had so many questions, so I said I'll address this. So now let's say we want to take a buy position that we said that the market structure for an uptrend is sort higher. Now, the moment we say that we want to take a buy over here, this is where what our trade is going to be executed at this green point or that I have placed over here, or this black point. Now, at this point over here, let's say that we want to put our stop loss here. Now, what did I tell you? I told you that for us to notify a change of trend, price has to come below the last higher low. So if you're in an uptrend and then you press buy, that means the last place that you would ever want your market price to reach is this point. That is the stop loss region. Now, a stop loss is an order type used in forex trading designed to limit your losses. And then also, it is what we also call the invalidation point. It means that you are just telling yourself that if I get to this point, I am wrong. It is no more a buy for me. And it helps you keep your money and then avoid losing all your money, that is blowing your account. Because one of the unhealthy things that you can ever do for a swing trader or a day trader is to be watching your trades like constantly. You get it? Instead of you doing something else, you're watching your trades constantly. It's not really going to help or even favor you. You get it? So a stop loss is a zone that you're just telling yourself that if I get here, then I am wrong. So you are protecting yourself. And then sometimes this can happen, even this. Let me clear all the drawings. Sometimes you can have this. Let's say that we are buying over here. We press the buy, and then this happens. And then let's say we've left our account. This is where our stop loss is. We are saying that when price gets here, and then there is a major news. And then it surpasses you, and then goes all the way down. If you don't have your stop loss here, your account can get margin call, what we call margin call, and then you're out. You get it? Similarly, we are having take profit. Now, take profit is simply an order type which you are just telling your broker that the moment I get here, I am fine with the amount of money that I have made. Please, I won't trade again or take me out of this trade position. As easy as that. As easy as it gets. So this is it. Let's say you want to take money here. The moment it gets here, the trade will close automatically and then your balance will change. So this is all that we are having for today. If I don't have any questions, we'll be ending here. The videos will be uploaded on YouTube in case you need anything. Any questions?
So I have a question.
Okay.
I was going through some of the pics in the Telegram and I saw sell, as in the bearish this one, and I saw profit, and I'm saying sometimes will you be planning to buy, then you gain profit, and at some point too you will sell and you gain profit?
Yeah, it works that way. That is what we call the recession proof about forex. Whether the market is
Okay.
going up or down, we still make money. See, so forex is a nice thing.
Okay.
Right? It's an interesting game.
Yeah.
Yeah.
Yes. Okay. So at some point you study the market and see it's going on selling pace. Then you decide to sell. Then you gain profit.
Yes, that's what we are doing. We are going to learn when to sell and then when to buy. And then basically, I've said that for you to buy, you should be in an uptrend or a bullish trend. And then for a sell, you should be in a bearish market or a downtrend.
Okay.
All right. Any other questions? Any other questions? Oh, okay. I forgot one thing. The sell limits, buy limits, sell stop. Okay. We'll do that tomorrow. The sell limit, the buy limit, the sell stop. Let me see if I can just go through that with you guys. Now, let's look at this. This particular currency provider. Let's say we want to, right now over here, we believe that this thing is a buy. But we believe that in an uptrend, it moves what? Higher high, higher low, higher high, higher low. So we are waiting for the higher low to get back for us to what? To take a trade. Now, with this kind of, if you want to wait for price to come back down and then execute a buy, the only limit that you can use is what? Is a buy limit. Now, a buy limit is a region below market price where you expect that what price will come and execute and then move back up. So, for example, when I right click this zone over here, let me clear all my drawings first. When I right click this zone over here, you're only going to see buy limits. Now, if I believe that market should go up and then execute my trade, yeah, I'm going to see a sell limit. You get the difference. Now, for a buy limit, market should be buying, already buying. You get it? And then market has gone beyond you. So you leave your buy limit below market price. Over here like this for a buy limit. Now for a sell limit, it should be above market price. Now, what if you believe that this thing will go up, but you are waiting for it to surpass? Yes, they are telling yourself, well, if it breaks this resistance over here, I will buy. Then all that you have to use is what? A buy stop. And then the moment price moves above that zone. So in case you want price to get to the zone, you go to a buy stop. And how do you execute a buy stop? You go to your new order and then you use what? The pending orders. Now, the moment you click on pending order, you're going to see buy limit, sell limit, buy stop, sell stop, buy stop limit, sell stop limit. You get it. So you just click on the buy stop because you believe that this thing will buy, and then you just continue with it. So you get to understand more of this on when I teach support and resistance. So I think tomorrow I'll either teach multiple time frame analysis or I'll teach support and resistance. Either way, it's going to work perfectly fine. And then we are going to understand the whole concept. So thank you very much for joining. If I do not have any other question, I'll end the session now. Any questions before I close the session?